Nigerian equity market is showing a measurable deterioration in internal breadth, and this is now becoming difficult to dismiss as ordinary market noise. Looking at the latest weekly breadth data, we have now recorded 4 consecutive weeks of deterioration in the advanced decline differential. The AD differential has moved from plus 19 4 weeks ago to minus 24, then minus 37, minus 33, and now minus 41. That is a significant deterioration in participation beneath the index. What is particularly important is that this weakness isn't confined to one breadth indicator. The percentage of NGX stocks trading above their 10-week moving average has fallen from 38% to just 21%. In other words, only about 1 stock in 5 is currently above its intermediate-term tactical trend. The 30-week picture is also deteriorating. The percentage of stocks above their 30-week moving average has declined from 51% to 30%. So we are seeing deterioration across both the intermediate-term and broader structural trend. But the most important number this week may actually be upside volume. Only 6% of total market volume was associated with advancing stocks. That's an extremely weak reading. Remember, price can sometimes decline on relatively light participation and recover quickly. But when advancing volume collapses to this degree, it tells us that buyers are becoming increasingly absent from the market's internal structure. The implication is not simply that prices are weak. Participation on the upside is weak. We also recorded 5 new 52-week lows this week. On its own, 5 new lows would not necessarily constitute a systemic warning. But that's not how we should interpret this number. It is occurring simultaneously with a negative and deteriorating AD differential. Only 21% of stocks above their 10-week average, only 30% above their 30-week average, and upside volume collapsing to 6%. The signals are therefore becoming internally consistent. From a quantitative perspective, this is what matters most. We aren't relying on a single indicator. We are observing multiple independent dimensions of market participation deteriorating at the same time. Breadth is weakening, trend anticipation is weakening, upside volume is weakening, and new lows are increasing. That combination suggests that the NGX is currently experiencing broad-based internal deterioration rather than a narrow pullback concentrated in a few stocks. So what should an NGX investor do with this information? Don't try to predict the bottom. Instead, let market breadth determine your level of aggression. With only 21% of stocks above their 10-week SMA and 30% above their 30-week SMA, I would not be aggressively adding new swing positions simply because individual stocks appear oversold. For a disciplined trend trader, this is a period for capital preservation, selectivity, and confirmation. I want to see breadth stabilize first, particularly an improvement in the AD differential, upside volume, and the percentage of stocks reclaiming their 10-week and 30-week averages. Until that happens, the data says, reduce aggression, protect capital, and wait for participation to return. That's the signal I'm watching next week. The question isn't whether the NGX is oversold. The question is whether participation is returning. Right now, the data says it isn't. If you'd like to stay ahead of the crowd by following what the market is doing beneath the surface, not just where the index closes, be sure to subscribe and join us again next week. This is Data Vesting. Trading with science, not emotions.